I taught this class 8 times, and you're going to find that the more you teach it, the better of a teacher you become. I'm a much better teacher after teaching it on the 8th time than I certainly was the first time. So what I have done over the years is I've tried to introduce a lot of personal stories. I've got daughters that are roughly the same age as some of these students, and they can relate to how I've interacted with my daughters, mistakes that my daughters have made through their financial journey. So they really appreciate real life stories that tie to the material. Throughout the courses, I try to give them a perspective of where I think that they should be in their financial literacy journey, especially with their banking relationships. So in the very first section of Bank Your Future, I stress, as does the course material, how important it is to have a banking relationship. And I challenge each of the kids that currently do not have savings account to try to work with their parents and at a minimum establish a savings account. And that fits very nicely into the Bank Your Future curriculum, addressing concepts like compounding interest, saving early, establishing banking relationships, not being intimidated by a banking relationship. A simple savings account, even with a minimal rate of interest, is going to do that. And if they're able to see just saving a couple of pennies through interest every month, it does become meaningful that your money is working for you. So I stress to the kids who do not yet have savings account to get a savings account, and I stress that throughout the Bank Your Future curriculum. Then the second part of the course, which is check it out, now we're into the checking account section. And I really encourage these kids who are juniors or seniors in high school that it really would be great to have a teen checking account. And I usually do a little research on, depending on what school I'm at, in terms of what banks or credit unions these kids or their families might have accounts with. And I try to understand what the offerings are in terms of the teen checking program at these institutions. So I'll use a couple of examples. I might use Educators Credit Union. I might use some of the national accounts. I might use a regional bank, like the Associated Bank. So I'll try to figure out what's out there that might be available to these kids. And I stress to them to start opening up a checking account. Not necessarily because I think they're going to be writing a lot of checks, because they're probably not going to be writing a lot of checks. But I tell them I think a checking account is what I call your in and out account. I'm hoping you're going to have a debit card, which doubles as your ATM card, which really is the way to primarily transact through your checking account. Not many kids are writing checks anymore. As a matter of fact, a lot of adults aren't writing many checks anymore. So your checking account is where you're going to, most importantly, when you get your first job, is where that direct deposit is going to take place into. So you're going to see money coming in through your direct deposit, and it's going to be coming out through ATM transactions and debit transactions, and maybe even the occasional check. The curriculum for Check It Out does a great job of going through those transactions, stressing how important it is to keep a good record of all those transactions. But then so now I've built upon the foundation of a savings account, which I think is relatively a static place to hold money and get a little interest out of it. And then a checking account, which I consider a more dynamic account that has transactions coming in and out all month long. And then what I stress is the interaction between the two. We talk about, okay, what happens if you've accumulated $500 in your checking account and you don't think you're going to be spending that kind of money in the near future? What might you want to do with that $500 or a portion of that $500? And then, of course, we talk about moving it over to your savings account where you have a better interest earning opportunity. So we talk about the interaction between those two accounts. And then the third step in the process, I believe, primarily when they're 18 years old, is to get a credit card. And I think that the best way for them to get a credit card is through the same financial institution that they have their savings account and their checking account already established. Because then they're going to set themselves up for a really nice three-pronged banking situation where they've got a savings account where they can earn interest and keep their money. They have a checking account, which again is the in and out of the daily transactions. And then they have a credit card, which moves very nicely into the third chapter that we teach, into the To Your Credit section. So To Your Credit, one of the main concepts in there is teaching them the principles of a credit card. And I like to tell them that having a credit card when you're 18 years old tied to your checking and savings account is a great thing for a number of reasons. And the most important reason is if you use it even on a minimal basis, and you pay off that balance every month, you are going to start setting yourselves up to establish a great credit history. And that, of course, fits very nicely into the section where we learn about credit scores and what drives credit scores and why a high credit score is a key factor in your financial success. So I really encourage them when they're 18, if they've done step 1 and 2, to take that third step, open up a credit card, even if it's a minimal credit limit, $250, maybe $500, to try to transact with that card at least once a month. And this is what I tell my daughters. I tell my daughters, I know you're going to have a debit card in your wallet, but I also want you to have a credit card in your wallet. And even if you're going to do a $5 transaction at Subway, every once in a while, pull out that credit card instead of your debit card, charge that purchase, and then pay that entire balance off before it becomes due in the next statement period. Again, why is that important? Because showing a consistent use of credit, even if it's a small dollar amount, and paying it off every month, starting when you're 18, establishes a good credit history. So that if you envision yourself being 22, 23 years old and wanting to buy your first car, you might need to take a car loan out, and a car loan is going to be a lot more attainable, along with being a lot more inexpensive if you've already established a sound credit history. So these are all concepts that I've shared with my daughters. I've taken both of the daughters through this process, and like anything else along the way, there's interesting bumps in the road. My youngest daughter, who will challenge me pretty much every step of the way as a parent, one of her first missteps was the very first time she wrote a check. She had a lot of money in her savings account because all along I was stressing, let's not leave more than $100 or $200 in your checking account. And whenever you get higher than that through your job, let's move it over to savings. So she had to write one big check, and she didn't have nearly the amount of money in her checking account to cover that amount. And I really wasn't aware that she was writing the check. And sure enough, one day when we were looking at her accounts, her checking account had $0.00 in it, and there was a significant reduction in her savings account. And I asked her, why is your checking account down to zero? And she told me about the check she wrote, which was for a dollar amount much greater than the amount she had. And she had no concept when she wrote that check that it was going to be taken out of her checking account. All she could think about is that collectively she had more than enough money to cover this account. So it was an assumption that I made, and obviously not a good assumption, that she would understand that there's a relationship between the check that she is writing and the balance in her checking account. Now, fortunately for her, the story did not have a bad financial ending, because when we set up her accounts, we established an overdraw situation with her savings account that the bank moved the money over from her savings account to her checking account without charging her any fees, which is fortunate and something that you're going to want to do if it's all possible. And again, that's why I stress it's really, I think, beneficial to establish a banking relationship with a single bank for these various stages of your financial progression as a teenager moving into your young adult years. The other interesting thing was when she wrote her very first check, it just happened to be to the town of Brookfield for a speeding ticket, which gave her a good appreciation for the value of $180 and being more careful when she's driving her car as a young driver. So there's a lot of life lessons that also go into some of our financial literacy lessons that the kids can relate to. The kids can relate to speeding tickets. The kids can relate to the fact that, hey, if you get a speeding ticket, you better have that money to pay it. And it certainly is good to have saved such that you can deal with those kind of financial bumps in the road.